This is the S2G podcast. I'm Tanya Bekritzes. In this episode, we dig into how macroeconomics are shaping markets, strategy, and opportunity with Dimitris Valatsas. This podcast is for informational purposes only and should not be construed as legal, business, tax, or investment advice, nor should it be used to evaluate any investment or security. It is not directed at or intended for any current or prospective investor in any investment vehicle sponsored by S2G. Investing involves risk, including the potential loss of capital. References to specific companies are for illustrative and educational purposes only and do not represent an endorsement or investment recommendation. The views expressed by podcast guests are their own and do not necessarily reflect the views of S2G. For additional important information, please visit s2ginvestments.com/disclosures.
We're currently undergoing a transition where investing to be at the forefront of AI has suddenly become extremely capital intensive. And that's felt in the economy. And I think that's part of the reason why real rates are picking up. A lot of capital has to be deployed in a very short period of time.
If you thought macroeconomics was just noise or too broad to be practical, think again. In the age of adaptation, when structural shifts are reshaping markets and the investment landscape, macro thinking may be more critical than ever. In this episode, Sanjeev Krishnan sits down with Dimitris Valatsas, founding partner at Aurora Macro Strategies, to make sense of today's macro environment and distill the implications for investors and operators. Sanjeev and Dimitris kick off the conversation with a quick macro one-on-one before going into three key topics: the price of money, as in the cost of capital and what it means for multiples; the price of machine intelligence, meaning AI's capital intensity and productivity potential; and the price of entropy, or how markets absorb climate, geopolitical, or other shocks. With a focus on the intersection of geopolitics and economics, Dimitris brings sharp examples, clear reasoning, actionable guidance, and a dose of measured optimism. So let's dive in.
All right, welcome to another podcast. I think we're going to continue our exploration to Age of Adaptation with Dimitris, who's the co-founding partner of Aurora Macro Strategies. What I wanted to really dissect for our audience is, what is macro? Number one. Number two, why does it matter, particularly if you're doing alternative investments, particularly in sort of our commodity sector areas of focus, and then just where we are today, where we're going. So with that, maybe before we get into all that, just tell me a little bit about yourself, where you grew up, a little bit about your biography.
Thanks, Sanjeev, and thank you so much for having me. It's great to see you. It's great to be on the podcast. So I guess I'll start at the beginning. I was born and raised in Athens, Greece, or a suburb about 45 minutes north of Athens, Greece. Grew up, I guess, from a macro perspective. This is the pre-Euro Greece, a lot of monetary policy impact, a lot of devaluations, and it was the kind of time where on the news at night, there was always an FX segment. It was standard, like before the sports, you'd have the FX people go on and tell you what the drachma to the lira and the drachma to the French franc and whatever was. And I don't know if that's what impacted me, but my dad says I decided to become an economist. I went to Harvard when I turned 18, then went to the UK for grad school, and started my career as an energy economist, working in European natural gas. European nat gas at the time and today, and always, has been incredibly geopolitically involved. And I discovered that what I was really interested in professionally was not the pure macro, not the pure demand and supply, but the interplay between geopolitics and macro. Meaning, how do geopolitical relationships affect the macroeconomy? How does that affect the macro factors that play into any investment? Unemployment, inflation, GDP growth, productivity growth. How do all these things play out, not in the ways the macroeconomic textbooks would tell you, but in the ways the real world does? And that's what I've been doing ever since. We founded Aurora Macro Strategies with my partner, Daniel Landsberg, 3 years ago, and we help corporates and investors understand the macroeconomic and geopolitical world and make smart decisions about how to position themselves in their investments, given what's going on geopolitically and macroeconomically.
One of the things that we are focused on are these sort of 4 or 5 transitions the world is going through: CPU to GPU, unipolar to multipolar, 1.5 to 2.1, maybe 2.5. There's a demographic question if that's a transition separately about depopulation. But an important one is the sort of dollar known price of money, if you will, to an unknown price of money. That's obviously core to what we're doing. I want to get into that later. But what is macro?
I think that's a great question. Look, for any person, any company working in a particular industry, there's company-specific trends that matter, particular investments that worked out, didn't work out, products that worked out, didn't work out. There's industry trends that matter, regulatory frameworks that move your industry this way or that way, and product and consumer preferences, et cetera. And then there's the macro. And the macro affects everyone. It's, are we going to be in a recession next year? No matter what business you're in, that's going to matter. Is unemployment going up? Are earnings going up? How is FX changing? And that affects different companies in different ways, but it matters for everyone. So for me, the definition of macro is that bit of economics that affects every actor, regardless of what sector they're involved in or what part of the economy they're in.
I've thought about it two ways as it relates to my career and alternative assets in general. And let me know how wrong this is. Two frameworks I have for this is I am not a poker player. If I was, I would be bad at it. But basically, it's like the table you choose is like half the performance of playing poker. So if you're the right table with people around you, I guess, that know how to play, you actually end up doing better. Two, Josh Lerner at Harvard Business School, I think he believes this around a lot of investing is vintage year. If you're in the right vintage year, you're going to perform better than a difficult vintage year. And that's certainly, I've lived that experience. I continue to live that experience. And I think that is true. Like for people in our ecosystem, is that like a fair way to think about macro as well? A lot of it are systemic assumptions that industries have to align themselves with and companies have to align themselves with.
I think that's right. And the vintage year aspect in particular, I think is incredibly important, especially when you're doing early stage and scaling. Like at some points, what matters most is how much capital is there out there, is what kind of opportunities is it chasing, what kind of valuation are you getting? So if you're at the top of the cycle, it's really hard to invest, not because you're a bad investor or a good investor or whatever. It just, that's where you are. It's the top of the cycle. When it rolls over, when the Fed hikes rates, when capital flows to safer investments, everything gets hit. And that's got little to do with individual skill. Like some people play better, some people played worse, but it's more to do with where the macroeconomy is, where the monetary cycle is, which I think is incredibly important. And unfortunately, I think quite overlooked by many early stage investors. A lot of it is narrative, is idea. It's a good idea. It's a powerful investment. It's a good team. When you're at the top of the cycle, that just won't matter as much. And again, it's not the individual investment. Perhaps it's not the individual story. It's not even how it plays out over 30 years. It's just your entry point. And I think macro is very helpful actually in discerning that.
It's interesting because you have a generation of investors and company builders that haven't really seen too many macro cycles, I would argue. I entered my career in 2000, but you tell me, but from 2009 to 22, I would argue, given what the Fed did and what central banks did, there was so much asset class correlation that occurred in many ways. Please feel free to actually state facts. But these are like some of my lived experience that in some ways was all macro. In some ways, because there was not so much correlation between different asset classes, we sleptwalk into a dislocation of capital potentially. Would you agree with that, or what would you think about that?
Well, look, from a kind of historical perspective, it's a really interesting period, right? So we exit 2009, the economy is really badly hurt, and global authorities basically decide we're going to do pedal to the metal monetary policy, so 0% interest rates all over the world. And for a couple of years, they also did fiscal, but then let off that. The Eurozone crisis was a significant factor. When you mention high correlations, actually the time around the Eurozone crisis, that was incredibly high correlations. Like you could tell me how the dollar did, and I could tell you how copper did. I think there's two things that happened from a macro perspective. One was that every central bank in the world was doing the same thing, which was lower rates. And that's a tough world if you're a global macro hedge fund and interest rates are 0% here, 0% Europe, 0% Japan. There's little you can do. But everyone was trying the same thing. The second aspect of that is that didn't work. So people went further. People did QE, places like Japan, negative rates, same the EU, things that hadn't really been tried before. And then right as things started normalizing, COVID hit, which was a once in multiple generations economic event, just in terms of the degree of economic contraction and expansion. Very few people in markets today would have seen anything like that. So we went back to all out easing, right? Just to prevent this happening again. And I think that, I don't know if sleptwalk is the right word, because some people were well aware of the risks, others less, but that led to the kind of valuation bubbles that we saw in 2021 and early 22 before the Fed really started hiking rates. But thinking about starting 2008, no one had really seen a real coordinated global hiking cycle. So 2022 came as a surprise to people.
You've been doing macro for a while. How is it different today than when you started doing it in your career?
That's a great question. I think part of it is what we've been talking about, fragmentation. China is playing a much more important role. The US is turning more inward. There's less coordination with allies. I think for pure macro, like close to the monetary policy world, again, I started my career in this zero rate world where everything was zero and growth was very tepid and things weren't really moving. We're definitely not there today. There's a much richer tapestry of inflation developments, of monetary policy developments around the world. China looks very different to the United States. The EU looks very different to the United States. Japan looks different to everyone. Emerging markets are going in all sorts of different directions. So I would say, in a sense, it's a lot richer. It's a lot more interesting. It's a lot more diverse than the early 2010s.
In terms of macro, what are like 5 obvious things you track as a macro thinker or analyzer?
If I had to list 5, labor market, because the Fed tracks the labor market. So we use the VU ratio, vacancies to unemployment. I focus a lot on what I call realized real interest rates. Hey, what's the Fed interest rate today? 4.5. What's inflation rate today? 2.8. The difference is the kind of real interest rate. It's not a very kosher measure from a pure theory perspective. You're only allowed to look at expectations, but also expectations are made up. I prefer the kind of real metrics. 3 is fiscal impetus or fiscal headwind. Is the deficit expanding or contracting? And what does that tell us about the economy? Steepness in the curve, I'll look at a lot. So how are future interest rates compared to today's interest rates? And then, for the day job, market expectations of future Fed rates. So where does the market think the Fed's going to move next week? What about October? What about December? Do I agree with that? Does that make sense? I think we reached 5.
Are there any non-obvious macro metrics you look at? As an example, when I was in Singapore, we would look at pork pricing as a proxy for Chinese consumer confidence, that kind of thing. Do you guys look at any non-obvious ways to measure?
We definitely do. We have a very long US chart book, a very long EU chart book. I think most interesting to our clients and to me are things that are hiding in plain sight. Probably the single most important variable for the course of the macroeconomy is the household savings rate. Consumption 70% of the economy, right? And the savings rate is basically the main thing that moves. Earnings move a little bit. If the savings rate shoots up, then you have a macroeconomic problem. This is what's happening in Europe, for example, today. I'm just back from Europe, and when I was preparing, looking at the macroeconomic data for my trip, I realized, okay, deficits are high, but household savings rates are really high. They're 15, 16, 18%. Just to compare that, in the US, it's 4.5, right? And they're not super directly comparable, but the scale is staggering. No one talks about the household savings rate in Europe. It's not considered to be a policy problem. It's not considered to be a political problem. It is the root cause of low growth.
It's an issue in China too, I know.
Right, of course, absolutely.
Yeah.
But people don't follow. It's more these kinds of data that if you're comprehensive, you get the political blind spots.
I'm a self-professed macro geek. I love this. I think there's a couple of things I want to get to that I think our companies, our audience, our corporate partners, as we're very strong, are really, levered to, for lack of a better word, in now and in the future. I'll start with the first topic, which is really the price of money. Where do you think the price of money is going to go, given debt and deficits, given though the potential for stagflation at the same time? What's your view of the price of money now and in the future?
So it really depends on the price of money we're talking about and the price of money we're facing. So why don't we lay these out? When I really think about the price of money, I think it's important to differentiate between real and nominal. interest rates. Most people talk about nominal interest rates because they face nominal interest rates. If you go to the bank, unless you are very sophisticated, they're probably not going to offer you a real interest rate on your mortgage, right? It's going to be a nominal interest rate, and you just have to deal with the inflation risk. But in reality, the economy should be able to shake that out. So what we're really thinking about is what kind of real interest rate do capital owners demand? Is that going up or down in a kind of secular fashion? And if we look at over the past 40 years, call it all the way to COVID, there was this period of great moderation. Some historians will argue this goes back 500 years. As our technology evolves, or as our financial technology evolves, real interest rates go down all the way to zero. And then came the disruption of COVID, and things started shaking up. Real interest rates started picking up. Now, when we think about why that happened, the period before COVID, Larry Summers called it secular stagnation. There were too many savings, essentially, and not enough investments, not enough productive ways to deploy capital. And what's happened since COVID is the savings are still there, but there is a tremendous amount of hugely capital-intensive investment opportunities that have appeared. It's a very long discussion, and I imagine also slightly outside my area of expertise. Is that going to work out over the next 2 years, 5 years, 10 years? That's a big question. But investment in power, investment in data centers, investment in GPUs, as you mentioned, all these things are extraordinarily capital intensive, which we're not used to, right? If we go back 10 years and you look at the same dominant companies as you do today, Meta, Microsoft, Alphabet, Amazon, right? They weren't what you call typically capital intensive industries, right? There wasn't mining, and they definitely weren't valued as capital intensive industries. And we're currently undergoing a transition where investing to be at the forefront of AI has suddenly become extremely capital intensive. And that's felt in the economy. And I think that's part of the reason why real rates are picking up. Government deficits are probably another reason. There's no coherent plan as to how we'll get the deficits to a sustainable point. But I think the real impetus is what's happening in AI and power investing in particular, where a lot of capital has to be deployed in a very short period of time.
We're going to get to the price of machine intelligence next topic. Staying on the price of money is maybe a US-centric view, but I have this notion of the Hippocratic Oath versus the bond market. If you go 1,000 years of history, the bond markets tend to win. And so let me ask the fundamental question. Do you think the bond market will regulate the fiscal issue in the US?
I would say no, but with a caveat. Obviously, the bond market regulates US fiscal posture, the ability of the US to raise debt and spend its deficit. The world looks very different with 4% nominal rates than it does with 1% nominal rates. I imagine the Senate would have behaved very differently in passing the fiscal bill this year had interest rates been 1% or 7%. So as a matter of theory and practice, yes, it matters a lot. Foreign demand matters, domestic demand matters, where these levels settle matters. And the Fed also doesn't have a ton of control over the long end of the interest rate curve. So there is a situation in which, yes, if the bond market rebels, there's got to be belt tightening, and belt tightening has to be found, and the Congress will have to concern itself with that. I would say that the US still enjoys this exorbitant privilege of borrowing in the reserve currency and of being able to do so in rates that are substantially lower than would otherwise be the case. The example I bring for people is, think of a country with a fiscal situation like the US, 6-7% fiscal deficit, over 100% debt to GDP. Where would you expect rates to? Think about Brazil, right? Something like that. You wouldn't expect 10-year rates domestic to be at 4%, right? They might be at 9, and they might be at 11. But the US has this extraordinary privilege that it is the supplier, the world supplier of safe assets. So it absorbs all these global savings. Now, I think this administration is pushing back against that consciously. Obviously, tariffs are meant to reduce the trade deficit. Reducing the trade deficit means less money flowing to US treasuries and all that. But the position is so dominant still that I think over the next, say, political cycle, I doubt we'll see a situation in which Congress has to act because the bond markets are acting up.
Some of our investments take 10 years, 7 years to mature. And so you're selling into a pretty unknown. If you look at the lenses like 7 to 12 years from now, is there tail risk associated with this where kicking people off Swift creates a bit of a Hegelian dialectic? And maybe Europe is the linchpin of this, because if they decide that they need to fund a lot more internally for fiscal growth, like how does this come apart? I assume it's not China and Russia and India getting together. I assume Japan needs to be involved and Europe needs to be involved to challenge sort of dollar dominance.
There's a few issues there. First, I would note that, sure, the debt is up, but so is net worth, household net worth. Mm-hmm. So what we love doing in our chart books is charting US debt, not just as a percent of GDP, but as a percent of net worth, because it's a liability and it's masked by assets elsewhere. And it doesn't look that scary if you look at it that lens. You're entirely right. Like, the rest of the world is not entirely happy with the situation. China, which is a very large economy and a very significant one, is not happy with the situation. India is not happy with the situation. Russia is not happy with the situation. Now, they've been unhappy for 20 years about the framework, the IMF, the Bretton Woods. Why does a European get to run the IMF every year? I'm European. I think it's a great idea. But I imagine if you're Chinese or Indian, it doesn't sound like as great an idea. But now they have the macroeconomic heft, and now the geopolitics have gotten more contentious. And I think that's a significant aspect. China has a closed capital account. It is very hard to be the global financial hegemon with a closed capital account. It's basically impossible, right? So that's a fundamental problem. So you think, well, who are the natural beneficiaries? And Barry Eichengreen has done excellent work on this. The money flowing out of US Treasuries as FX reserves. Some of it goes to Europe. Some of it goes to Japan. A lot of it goes to what you'd call like tier 2 reserve currencies like Canadian dollar, Norwegian krone, Aussie dollar, all these slightly more lightweight actors that still have very robust institutional frameworks. So I don't think it's a kind of one-to-one transformation. I share your skepticism that Russia, India, and China will be able to create an alternative financial system. I think that's rather unlikely. The most likely outcome is more fragmentation, a little bit more multipolarity, but still with the US being over the horizon you laid out, 7, 10, probably 20 years, the undisputed center of the global financial system.
So on the price of money, your view is there's tail risk, but right now it's still a dollar world.
I think it's definitely a dollar world. I wouldn't call it a tail risk in the sense that I think it is happening. I don't think it's a risk that might happen. The important question is, to what extent does that raise borrowing rates here in the US, becoming less important as a global currency? And I think that's an important question to think about.
Is there an upper limit to the 10? Because the way that I've always was taught was the front end of the curve is like short term, like interest rate, Fed, inflation, sort of unemployment. The long end is about trust a lot, as well as the fiscal position. Is that still an appropriate way to think about it? Because the 30-year is high at the moment comparatively.
It can go a lot higher. And again, we're talking about nominal rates. If you do things like unwisely cut into a stagflationary wave, for example,
it could go higher.
It could go a lot higher. It could easily.
And a lot of the real estate loans, mortgages, a lot of debt for infrastructure, which is what a lot of our companies are focused on. Obviously, this is an important metric, the 10-year especially.
Absolutely. And I think what matters is, so say you're investing in a long run, like energy facility, right? Are your returns inflation indexed? If they are, you have less to worry about. And a lot of the nuclear facilities coming up in Europe work like that, right? You finance at a nominal rate, and then your returns are inflation indexed. So you might even be better off if there's an unexpected inflation spike.
So the advice would be, like, your offtake better be in inflation indexed. Otherwise, you're compressing.
Definitely. You definitely don't want to find yourself in a situation where you have to refi at higher rates without being able to raise prices. That's the worst of all worlds. And a lot of companies are in that situation, and CRE has been in that situation. So it's extraordinarily important. Obviously, it's extraordinarily important. That's what we advise people on, to understand the differences between what's happening nominal and real on your cost of capital, what's happening nominal and real on your revenue stream.
And I think just to bring it back to our audience, like, we talk a lot about, are you getting multiple expansion when you're buying this company or multiple compression? Normally you model everything when you buy a business to multiple And this is like a mega way of what I'm trying to get at is when we go sell assets or we buy assets in the future, it's the mother of all multiple expansions, mother of all multiple
Correct.
compressions. This is what we're talking about. And I think you're saying it's really hard to call right now. Probably more multiple stability because of just lots of puts and takes, but there is tail risk to massive multiple compression if suddenly the dollar gets completely trampled.
Correct. And not to punt the question entirely, but I think it will depend on AI and productivity. That's the key variable. Oh, you got to get right is how does AI and productivity work out? Because if we get a massive productivity expansion, it doesn't matter what the debt is today.
Yep, I totally agree. So the second topic was the price of machine intelligence. So we've had this notion of taking now electricity and tokenizing it and trying to put it into different forms. And I was always taught, again, correct me if I'm wrong, like GDP growth is changing demographics multiplied by the change in productivity, typically equals GDP growth. Changing demographics probably in decline for a lot of the OECD countries. I know it is a hotly debated topic on the measurement of productivity and total factor productivity, labor productivity, et cetera. But it seems like the market wants to believe that tokenization of this electricity will create actually economic-wide productivity. How much of what I just said was accurate in terms of logic?
The only piece I would add there is probably capital deepening. And I will only add that because that's how I like thinking about AI. But I think you're on the right track. It's possible we'll record the first demographic decline in the history of the United States this year. It's not the base case, but it slowed down a lot, obviously because of immigration, much tougher immigration policy with the administration. Not true of every OECD country. Canada, for example, has robust demographic growth. Spain is another great example of once you solve the kind of immigration riddle, you can get a lot of growth out of that. But that's not the most interesting part. I think the most interesting part is productivity. You're correct. Total factor productivity is the black hole of economics. It is literally the residual, can't be measured. So we come up with it to make the rest of the statistics fit. That's a hard thing to put all our money on. But what's broadly happening from a macro perspective? What's broadly happening is we discover this new technology that can absorb a lot of capital. And as it absorbs capital, meaning GPUs and electricity and all these things, it creates a new form of capital. It creates a model that you and I can deploy in our work and save a lot of person hours, right? That you'd otherwise have to compensate to do this. My favorite example of conceptualizing this is compare an Uber to a fully automated car, right? You take a taxi from the airport. There's a driver in it. You pay at the end. And something like 60% of what you paid goes to the driver. The rest goes to the medallion owner, the car owner, the infrastructure, the parking guys, whatever. Maintenance of the car, the owner of the car. But roughly speaking, in the economy, 60% of labor, 40% of capital. If you take a Waymo, if you take a fully autonomous vehicle, for all intents and purposes, it all goes to capital. A machine's driving the car, right? That's capital that someone owns. It's run by an algorithm that's also capital that someone owns, and the car itself is capital that someone owns. So we've discovered this way to take away labor requirements and produce things with more capital. Now that requires, more capital, right? And the bet is that we're going to be better at scaling that than we are at scaling people, which I guess ties into your demographic question from before. Now, conceptually, what's the big capital innovation there? It's the self-driving algorithm. And that takes years of research and human capital and actual capital deployed to come up with a model. And then it takes some capital, energy, et cetera, to actually keep it running. But that's the way to think about it. So you have a very intense capital deepening. You need a lot more capital than we had before, but you need a lot less labor. And that shows up as massive productivity increases because for every hour worked, you should get a lot more product. If that is true, or at least largely true, we should expect much higher productivity growth and much higher GDP growth than we've had at any point since the 60s, probably. And that makes all those debt questions and current liabilities questions kind of irrelevant. Unfortunately, it works like that in the theory, and it's a straight line that goes up in the theory. In practice, it doesn't. In practice, there's a very real possibility that we find ourselves next year wondering, why on earth were we paying these multiples for AI companies that no one has figured out how to use? Why did we triple Americans' electricity costs to generate sonnets faster, et cetera, et cetera? And that's happened multiple times in the past. There's a possibility that we're in way over our skis, but that's the theory.
And so I think it's like a TBD, but the world certainly is betting that this price of machine intelligence is worth it because we are making a lot of investments in this area. And it seems like we're radicalizing a lot on AI. Like, I think there are parts of the country, mainly Silicon Valley, but that just are like, have built it like a religion almost. Hey, we believe that this is going to transform everything. Even though many of those people lived through 99, 2000, and they still say this time is different, and really credible figures. And then there are people that are Luddites, perhaps by those people that are like, hey, I'm not sure this leads to actual productivity in the economy. Similar to our conversation earlier, it's a little bit TBD is what I'm hearing you say from just a pure numbers perspective. It's not shown up yet in productivity data. It's not shown up in whatever way you do total fat productivity data.
To be fair, nothing shows up in the productivity data until it's well after it's been established and delivered the productivity. That's just a data collection issue. It takes time. I wouldn't be looking there. In fact, what we're looking at is the microeconomic evidence. There's a lot of professionals. MIT has a tremendous roster of people working on this who look at, okay, can we get evidence from companies on actual productivity improvements? And we've had enough data to find out that, like, for many tasks, customer service is an excellent one because it's highly outsourced, et cetera. Like, you can see tangible, real productivity improvements, and you can measure those. Lower reaction times, better resolutions, higher scores, better employee satisfaction even. There is some micro evidence of that. And then on the other side, large-scale deployment is yet to show up in corporate earnings. It shows up in the people selling it, but it doesn't show up in the people buying it. So in Wall Street parlance, I think we're still in a situation where the customer's yacht rather than the provider's yacht. It's way, way too soon to tell. I think the reason I have some deference to the Silicon Valley religious aspect of it is A, because they're making it and it's pretty awesome. And B, because true, from a macroeconomic perspective, if this works, it will be the biggest transformation since the Industrial Revolution. It will not be like the 90s. It will not be like the 60s. It will be that big.
I totally agree. And I think we need it almost from a small C perspective, capital. And we need it just because I think there's a number of positives that it could drive. Having said that, I do worry about, is it going to be disinflationary or deflationary? Because if this ends up accreting to only capital and not to labor at all, it's going to require serious Gini coefficient and inequities. Do you have a view yet? I guess it's a bit early given our conversation so far, that if this is deflationary and the consumer benefits, similar to how they benefited from advertisers paying for the internet and subsidizing it effectively, it goes into this singularity abundance notion of techno-utopia. But won't a lot of that depend on more antitrust and regulatory regimes as much on that as opposed to just the pure market forces?
I think those are all fantastic questions. And they edge into the realm of what I call sci-fi macro, because you kind of have to think in exponential terms for it. The theory will tell you real wage growth will go up. The share of capital will go way up. You're going to have to figure out a way to redistribute that from capital to the rest of the world. And that's the political system's job, is to figure out how to redistribute that. And you made a fourth point there, which was around antitrust. I think that also has a technical component. You'll remember when DeepSeek came out, people were kind of shocked. And they were like, wait, maybe the moat around these things isn't as great as we thought. And maybe spending $50 billion a year to build a moat isn't that great an investment. I think the jury's still out on that. And it's more a technical question. It's a great technical question because the question is, where will the rents accrue? So I use Microsoft Copilot to prepare my slides for the S2G presentation, right? And that means I'm using Microsoft and I'm using OpenAI, but the value of it accrues primarily to Aurora and S2G because it's not, frankly, not that expensive. Is that going to be the case? Or in the future, are we all going to be renting our production model from Microsoft? And are the rents going to accrue there? What kind of interesting political economy situations does that create? It's way too early to think about the dystopia in which 4 companies run the world and you're either team this, team that, or whatever. And I have enough faith in the political system that a solution will be found to make sure that when 99% of output accrues to capital, it doesn't all end up with the same 5 people.
I do too, but I think you and I are in the minority, honestly, because I'm like, I think rule of law will prevail. I think democracy will prevail. I think we're going to figure all this out, because if you have disinflation and productivity, there's enough money to go around to solve the inequities. But having said that, I know there's a ton of dystopia in every segment of our economy and political realm right now. And I'll speak for myself, very Pollyannish. I'm like, this could be not a bad thing. The third topic, and it's going to be our final sort of topic, is the price of entropy. It goes into a little bit how I view, and I think we view, climate transition. The way I've defined it personally is this equation of taking useful energy and turning into useful materials. And humans have been doing climate transitions for 10,000 years. We've taken fire, then photosynthesis, then fossil fuels, all of which are taking useful energy and turning into useful materials. And then the fourth is whatever comes next. It's going to be most likely, given our politics, and all the above approach. But that's on one part of the ledger. The other part of the ledger is just environmental physics, just having more entropy. But it's not just climate, but you have things like pandemics occur and just increased geopolitics occur. I don't want this to be about climate specifically, but you can wrap it in if you'd like. Just how does the fat tail get addressed by macro markets? Is it something that only occurs once you see evidence of it, and so it ends up being more of a lagging indicator as opposed to a leading indicator? How are macro markets looking at entropy in any form, geopolitical form, environmental physics form?
Yeah, the simplistic answer would be they're not, because it's too far in the future, it's too distant. But I think that would be too simplistic. The classic example would be State Farm, which stopped writing insurance policies for Pacific Palisades 18 months or something like that before the devastating fire there, because they were acutely aware of the risks. This was a case in which markets were, in fact, ahead of reality and discounted something that would happen in the future and did a good job at it, which is terrible for the people who want to live in Pacific Palisades. But from a market's perspective, that was very efficient operation. It's clear that market structures have not served prevention of the climate transition. They've been miserable at it, right? They totally missed it. This is why we need policy intervention and why we've been having COPs for 30 years or whatever, and Kyoto protocols and things like that. It's because by itself, the market just can't internalize the damage. And free markets are good for many things. Perhaps they're not the way you want to solve climate change or giant systemic implications for the environment, because a lot of them operate by trial and error. And you only got one shot at this. And I'm pretty sure we've blown it, right? We're going to end up with significant heating of the planet and dealing with all the consequences of that. So my sense is markets are not really well designed to cope with this and performing accordingly.
Externalities is not something that markets are well designed to figure out. But when they get priced, do you feel like that's a way for markets to absorb it? Or even when you price externalities, it's hard for them to fully?
I think it can be. A lot of the problem is time and consistency. For example, we have an EV credit in the United States that's going to expire on September 30th. I don't think the need for electric vehicles is going to expire on September 30th. I don't think the technological imperative is going to expire on September 30th. But change the administration brings a different policy. So it's kind of hard for the economic system to totally adapt if you give it such a probabilistic price function, essentially. So you're saying, hey, I'm going to penalize you if you don't do X. But really, they know that, okay, let's wait and see the elections in 2 years, then we'll see about that.
I guess I have some faith that humans love collective magical thinking, and particularly fiat thinking. And at some point, see gold, see crypto, frankly, see fiat currencies. And so there is like some hope I have that we can price a fiat externality, even if it's real, we've priced other things before that have no economic quote unquote value, but represent a certain hedge or a certain, is that too?
Yeah, and to be clear, I don't think we should take an overly US focused perspective here. Look at what China has done with electric vehicles, which is phenomenal. It is unique in the history of industrial manufacturing to get to such a complex product so quickly and be completely dominant in it so quickly. Even 5 years ago, we wouldn't have placed Chinese manufacturers in the top 5, never mind the undisputed lead from the industry. Look at emissions in the European Union and the United Kingdom. They have collapsed without a collapse in GDP per capita, which is the major fear, right? That energy is what fuels economic activity. We have figured out ways to do this. We've figured out ways to adapt. It's just that we have political economy coordination problems that will end up with a much more suboptimal solution.
I have one final ask, and thank you very much for coming to our summit. Hopefully you met some good people. Our community, it's corporates, it's policy, it's our portfolio companies, it's our investors and co-investors. I want you to give one assumption that you think will hold true for the next 5 to 10 years that will be benefit to the community that we're trying to engage. And I have a joke, though, to give you some time.
Yeah.
That I think everyone knows probably this joke, but it's like the joke about there's like an economist, a physicist, and a chemist stranded on an island, and they discover this can of tuna. And the chemist tries to blow it up, finding some gunpowder. The physicist finds some mirror, and they try to do a laser to open it up. And the economist says, let's just assume a can opener.
Assume a can opener. I like it.
What can opener should our community, in your view, assume? And maybe make a twist. What assumptions should we challenge that are kind of group thinky at the moment?
Okay, so I think what you should assume is that AI is coming for your industry. And I think, to be fair, that's a bit of a cop-out because most of the people I met at the summit are well aware of this and well prepared. But I think it's important enough to double down what it means for your capital intensity, what it means for your product, what it means for your innovation speed. The required capital returns will go up. The required innovation speed will go up. And if you like what you do, that's really exciting. That's good news. And I'd be quite excited about it. So AI is coming for your industry. I think will hold with a high degree of confidence over the next 5 to 10 years. Assumptions I would challenge is don't assume, as I think most of the geopolitics world does, that the US and China are destined for war. I think there is a world in which the two nations can cooperate a lot more than they are today. I think that we can actually reach a more stable equilibrium in the next 5 to 10 years of more cooperation and more openness than we've seen in the past. And that would be my challenge in the group thing. Again, from an optimistic perspective.
They call it the dismal science, but I like ending on the note of optimism. So thank you again so much for agreeing to speak at our summit, agreeing to our podcast, and we're going to rope you into our community, whether you like it or not.
Thank you, Sanjeev. Thanks very much for having me. I really enjoyed this.
Thank you for tuning in to the S2G podcast. If you enjoyed this episode, please subscribe, leave us a review, or share it with a friend. For more information or to connect with us, check out s2ginvestments.com.